Hello, welcome everyone. My name is Lori Berman. I'm Vice President of Membership and Development for the Small Business Association of Michigan. Thank you for being here today for today's webinar. It's presented in partnership with PNC. It's Strategic Positioning for Business Owners Year-End Planning. We have a great panel lined up for you today. Very excited that you'd be a part of it. Just a couple of notes of points of interest. This is going to be pushed out on Facebook Live as well. It will also be on Zoom and be recorded, so you'll be able to watch it on either later. We'll send you the link so you could watch it again or share it with friends. We have questions and answers available for you today. We have someone special answering questions. If you have questions, please use the Q&A feature, not the chat feature. If you have questions unrelated to today's topic, whether it be loans or something else, small business, please send it to sbam@sbam.org. And with that, I will turn it over to today's moderator. Our moderator today is Rob Fowler. Rob is the CEO of the Small Business Association of Michigan. Rob, I'll let you take it away.
All right, Lori, thank you so much. And I also want to welcome you to our webinar today. This webinar is actually part of an ongoing effort for those of us at the Small Business Association of Michigan to help small businesses navigate this pandemic. And we've done a whole series of webinars, all of which are available on our website. This one seemed particularly timely as we find ourselves at the end of third quarter, beginning of fourth quarter, in a year kind of like no other. And we found ourselves in a conversation recently with some experts at PNC Bank, and it just seemed like this was a good and timely subject. So we appreciate our partnership with PNC, appreciate the sponsorship or support of Tim Salisbury, who leads PNC in mid-Michigan, and it's been a terrific partnership. I want to introduce our three speakers today, and then we'll just jump right in. Our three speakers are Mark Rheaume. Mark is the Senior Vice President for PNC, a Senior Wealth Strategist. He is a lawyer and a CEPA, a Certified Exit Planning Advisor. Dan Hoops, also a Vice President and Senior Wealth Strategist at PNC Bank, also a lawyer, a recovering lawyer, Dan, I've heard you say, and a CEPA as well, a Certified Exit Planning Advisor. And our third panelist is Julie Williams. Julie is the Executive Vice President for PNC Bank, the national lead in the area of ESOP solutions and business succession for PNC Bank. So we appreciate the three of you being here. Let's jump right in. I mentioned you were kind of at the end of third quarter, beginning of the fourth quarter. And I know that you have talked about how important it is to align the business owner's sort of personal goals as well as their business goals. And so Mark, let me turn it to you. Why is that so important?
Well, let me say just initially, we at PNC Bank sincerely appreciate, Rob, this opportunity to present to our business audience today. You know, as I was thinking about it and preparing for today, I was reminded of an ancient saying, "May you live in interesting times." Now that has been viewed as a blessing. It has been viewed as a curse. In any event, undoubtedly, we find ourselves in the most interesting of times. And so, you know, with that as an introduction, we have sort of unimaginable challenges before us. We have both a staggering loss of lives and a staggering loss of businesses as well. Just this morning, reported in Chicago, the old Palmer House that's been in existence since 1875 closed their doors. Things that were really unimaginable, that withstood the time of over 100 years. And so it is an extremely important time. Not only that, we find a serious level of government intervention with the PPP loans, with the CARES Act, a lot of things that have been thrown our way, with the Internal Revenue Service creating rules to help access funds to IRAs, to qualified plan benefits. So from a planning perspective, this is probably the most interesting time that I've seen in my life. And it's really critical that we focus a bit on alignment. And so this is probably the one area that I see often missing in good business planning. And what I mean by that is, COVID has forced us to adapt in the business environment as quickly as possible, really rapid development. How do we work remotely? How do we contact our supply side? How do we reach our customers? How do we react to a changing environment? But oftentimes what we find is there is an imbalance, and that imbalance is what we at PNC view as sort of a good offense and a good defense, using the football strategy. We're going to exclude the Lions from that football strategy at the moment. But we're talking about a real strong balance of personal alignment. What are your personal goals? And how do they align with the attractiveness of the business? An imbalance of one or the other generally reveals a significant weakness in terms of predicting successful outcomes. So we're going to spend a little bit of time on this first question, just talking about what do we mean by alignment? Why is it so important? Why is it so important to have a great defense? So our two themes are A, attractiveness of the business in the COVID environment, and then B, the personal and financial readiness. And it's the readiness that we find often a lack of attention. And the more they're aligned, the more likely we're going to get to successful planning outcomes. So what do we mean by that? Simply we start with the question of, what does life look like after business? How do we develop a 3 to 5 year personal vision? How do we de-risk, not only in the business sense, but in a personal financial plan? And fundamentally, how do we obtain really great counsel? So let me just begin with an overarching perspective on financial planning. Studies show that the first 5 to 10 years in transition drive a successful outcome. And there are two critical components to that: market valuation and yield, at or near transition or retirement, if that's the case. And why is this so important? Well, historically, we've always dealt with an old rule, which we refer to as sustainable withdrawal rate. So, for example, in planning for personal outcomes, we have generally spoken for decades, by the way, of a traditional 4% rule, which posits that retirees can safely withdraw 4% of their retirement funds without running out of money. Well, this convention is extremely challenged today. We have challenge to market fluctuations, fair market value of our holdings, and we certainly have charges to the yield factor. So we basically find that more attention needs to be focused on the personal planning and goals so that we can successfully transition and move the business to our desired outcome. Really what we're talking about is a dynamic planning process. If there's a couple words that are perhaps overused, one of which is unprecedented, the other is dynamic. We are in one of the most dynamic environments we've ever seen. So we find a strong need at PNC Bank to work with our business owners who typically their business represents roughly 90% of their balance sheet. How do we begin focusing on the personal, emotional, dynamic aspects? How do we balance that equation? Dan, why don't you talk a little bit about how we work with individuals on getting this planning arranged from a e-money standpoint?
Yeah, sure. So thanks, Mark. So one of the things that Mark and I have an interesting position at PNC, in addition to being wealth strategists, which typically would be concentrating on the individual's personal financial picture, but he and I also have the role as being private business strategists. So we'll look at the individual's business interest. And so one of the things that we're able to do at PNC is we've got a program called e-money, where we're able to sit down with a client and we can essentially plug in the various assets that they might have, whether they're investment assets, whether it's a business asset, or maybe they've sold their business and they've got, for example, a payment over time, and we can enter those payments in, real estate and the like. And we're able to give our clients an accurate snapshot where we can actually put a rating on the likelihood that this would happen, so that a lot of our clients can look at their retirement future and figure out just what exactly do I need in order to retire and live comfortably, once I've transitioned out of my business. And so it's a nice little tool. And so it also can ebb and flow. I mean, during the times where the market's going up and down, our e-money program is designed to take those things into account. And so, it's an interesting thing when you can sit down with a client pre-COVID and look at their retirement plan through e-money, update it, sometime, when isolation begins, and see where things might be sitting, and then do it again. And so it's a program that we are able to use, and Mark and I are able to use it when we're dealing with small business owners to essentially do what he's been saying, alignment, because, there's a tremendous amount of overlap between a business and personal interest. And we need to be able to integrate these into what we're trying to do. And so one of the things that we're able to sit down with our clients is we're able to figure out from a family business standpoint, if that happens to be the case, we can dive down inside to figure out exactly what do they need in order to sell, transition, gift, or however they're planning on transitioning their business. And we can integrate that back into our e-money program. But, one of the things that Mark and I have been going a little crazy with lately is just essentially trying to get planning and getting clients to sit down and understand the urgency right now with COVID. Because one of the things we want to make sure we're doing is that we avoid people being flat-footed by the time we get to the end of the year. And this is something that, you and I, Mark, sat through in 2009 and 2010 with a lot of the tax legislation that was coming out. People weren't sure what was going to happen, but we as planners were able to sit down with people and figure out, this is what you're going to need to do year end. And since we're having this conversation right now in September, we're at least giving people an opportunity to figure out, how do I align my personal with my business, with the prospect of the end of the year coming to us. So just a little opening there for you.
Yeah, that's really fundamentally important, Dan. I completely agree. It's not unusual for us to meet with business owners and say, do you think you're subject to estate tax? Where are you in terms of overall valuation of your estate, and really not have a good feel for that. So how much do you need for retirement? What does that look like? And and there is the fundamental cornerstone, which oftentimes is the estate plan. So what Dan and I often say is, let's make sure you can understand your estate plan sort of in plain English. In other words, how are your stakeholders affected, and are you comfortable with it? Secondly, and probably most importantly, we have seen tragedy. We have seen actual occurrences of shareholders passing. And it's not unusual for us to see tragically out-of-date provisions in estate planning documents. And this really does become tragic when documents are left just sitting on a shelf somewhere, and they're not actively thought of in terms of how are the stakeholders affected. So we really work hard at understanding who is affected personally and what is to follow with respect to your legacy. Lots of changing issues in the estate planning area. All of our powers of attorney need to be updated. We have video conferencing, HIPAA waivers, directions regarding intubation, ventilators, need for digital asset planning. And what we're saying is, we feel a strong need to focus on the legacy. Okay, we understand the business is primary. Now, how does that legacy continue? What are the cornerstones for passing on that legacy? And how do we optimize that by understanding and aligning the personal circumstances?
So Mark, I think a lot of business owners had a plan going into this pandemic. My guess is everybody's plan has changed to some degree, and it might be good just to step back and think about, what are the alternatives for transferring business assets at a time like this?
Yes. Dan, you want to begin?
Sure. Well, and as you'll see on the next slide, something that Mark and I might refer to as internal and external transfers. I'll speak a little bit about the internal transfer side here. But this involves essentially planning. This could be part of your estate planning. This could also be part of your business planning. It could be part of your exit strategy. But internal essentially involves transfers within the family or within the employee group, where a lot of times you might have a multi-generational family-owned business. And so this is the kind of thing that we like to sit down with the family business owner and work in conjunction with their estate plan. Because a lot of times what can happen is you could set yourself up with a plan that hasn't been thought out, and all of the possible things that could come, whether it's from legislation or something like COVID, and you're just not prepared for it. So there are a lot of different ways that we can do this, thinking about the estate tax, thinking about the gift tax consequences, thinking about a sale. But essentially, there really isn't a black and white rule as it comes to an internal transfer within the family, because you could essentially have a straight up gift of a business ownership interest to the family members, but that could trigger estate and gift tax consequences to the business owner, right now, or perhaps upon death. You could have a straight up sale to the family members. But again, just like you said, Rob, with COVID, plans are kind of out the door, and the valuation could be affected, or perhaps the payment terms could be effective. It's possible the sale price terms are too low. And so, we would have to think about, well, would the IRS come in and recharacterize part of this as a gift? So a lot of times we have to think these things through. Do we do a part gift or a part sale within the family? But then probably one of the things that you want to think about is what happens with the estate plan with the remaining family members who might not be involved in the business. And so, there is a little bit of a rule of thumb between some professionals where they actually prefer a part sale, part gift, because they think that it would motivate the next generation to have a little bit of motivation as they come in. But a lot of this, what we have to figure out is what works best for the particular client and with the particular with the particular business, and also with the family members who are going to be succeeding it. Because you have to understand, with a lot of small business owners, as Mark said, about 90% of their estate could be comprised of this business itself. So again, we have to look at a lot of the overlap between the business and the personal interests. Now, the other part of it is when you're dealing with a sale within the particular company itself to existing key employees who might not be related to the business owner. Those are also transfers that we have to think about. What's the best way to do it with the payment terms, whether or not we're going to have life insurance as part of this. So a lot of these transfers are very unique, every single one of them. There isn't, like I said, there isn't a black and white rule in which we're going to do it. And the final one, which I'm going to let my friend Julie talk about later on, deals with ESOPs, which is a very specific type of a transfer within a particular company. And so, most of the internal transfers that we look at, Mark and I have to do a lot of analysis between the family dynamic, between the business itself, between the key employees. We want to make sure that we don't have any ripples down the road, because nothing would be worse than to have a transfer of the business and then to have on the other side of the coin a will contest because somebody's upset about the way the business was transferred within that family. So Mark, if you want to talk a little bit about the external.
Yeah, well, underlying Dan's premise is this statistic that 83% of business owners have no written transition plan. I've been with owners that say they have a plan, it's in their head, or, I'm thinking about a plan, but really knowing your options and exploring those alternatives is the key. And we do that through really active dialogue. I just want to talk a little bit about management buyouts because I think that's particularly interesting. It really involves weighing of the pros and cons. Clearly, you have continuity of management, which is really helpful. But basically, you have illiquid buyers, generally a lower price, probably seller financing, and ultimately the question, are employees effective entrepreneurs? I had a recent case where a really nice business, we work the owner through the personal planning. In other words, how much do you need to take out of the business, given that your goal is a management buyout? So we took them through personal planning and basically said, if you net X millions of dollars, you should be set for life. So he had his company evaluated by his CPA, and the valuation came very, very low. Well, the interesting thing about that, I said, let me understand the valuation. Well, it turns out there was a formula for employees which was overly generous. And by that, I mean it was an old formula, which really substantially bonused employees. There were about 4 or 5 of them to the tune of, $500,000 bonuses. Well, they're clearly in excess of fair market value of what we might ultimately pay a normal employee. So what we had to do was adjust earnings. So we went through an exercise after bringing in an investment banker to really restate earnings and then educate management in terms of what is real value. Because in effect, we had to mediate between management and owner. What is a reasonable value and how do we get there? And even when you do that successfully and meet those challenges, you've got other issues, which requires generally, strong banking relationship and leverage. And so management buyout is particularly challenging. All options are certainly available. The question is, begin having a dialogue with good counsel as to how we begin attacking this. The other 2 external alternatives are strategic buyer and private equity. Historically, one would say that a strategic buyer will pay a premium. We don't find that's applicable any longer. Private equity is now in a position of having a lot of cash, a need to deploy that cash, and so they are very, very competitive. So the notion of who's going to pay the optimal price, you really don't know until you test the market. So I think the first prudent thing to do is think about establishing what we call an A team or an advisory team. That is a multidisciplined team that can help you understand in dialogue not only the personal alignment, but all of these alternatives and line them up to achieve your objectives. Now, the objectives are going to value, as Dan said, every case is going to be different. Do you need the optimum price? If not, what are your goals? If management is clearly your main objective, then we really have to go through and weigh the pros and cons. Strategic buyers are always very interesting. I'll just speak one other time of a recent case, a construction company. We met in February and we started having this dialogue of how are you situated personally? What would you need? When would you be willing to transition your business? It led to a really strong development of, if I could really package my company, I think it would be awesome. So we took them through several steps of identifying likely buyers, and it turned out that he identified a buyer. We had to sort of tune up the company in the last 4 or 5 months. We had to change accounting firms. We had to change law firms. We had to prepare this company for presentation. And we have since signed a LOI, letter of intent, and they'll be closing in December. But the steps are really important. So when I say good counsel, I mean all the accounting has to be tip top. You have to understand due diligence issues on review. And counsel really must be prepared to deal with alternative planning so that we can get a true understanding of what is desired and how to achieve it. So there are a lot of alternatives, as you can see from this slide. And it's a very interesting dialogue to proactively plan this process.
Yeah, Dan, you mentioned ESOPs, and I do think that while we have that slide up, let's kind of transition into that piece of it. Julie, I want to bring you into this conversation. An employee stock ownership plan or an ESOP is not something that a lot of small businesses are probably all that familiar with. It is not sort of common terminology among a lot of small businesses. Would you just kind of walk us through what is an ESOP, how does it work, and how can it be an alternative here?
Sure. So an ESOP at its core, at its most basic level, is a defined contribution qualified retirement plan, similar to a 401k. But ESOPs have some pretty unique features that when you take in combination with each other, they make it a tool for business owners to be able to transition their business or sell their business to their employees, either in part or in whole over time. If we could advance the slide, please. The unique features with, thank you, the unique features of ESOPs that really kind of are at the core of this tool is that ESOPs are allowed to borrow, in that the intent of it, the proceeds of those borrowed funds is to buy stock of the sponsoring company. So the trust, this retirement trust, buys the stock of the company, and employees will receive allocations of shares over time, typically on the basis of payroll. These plans are intended to be broad-based employee ownership plans. They're not intended or typically used for companies or owners to sell their business to a select or a key group of senior leadership. That's a really important distinction to keep in mind. The trust itself is the shareholder. The employees are beneficiaries. So another thing to remember is that the employees of an ESOP company are not direct shareholders. And that really is important as you go down the path. They'll achieve all of the economic benefits of ownership without being direct shareholders, which is important to the ongoing management and leadership of the business. The employees will receive the value of their vested shares at the time that they leave the company, so either at retirement, death, disability, or when they leave the company for other purposes. ESOPs are funded by the company. Typically, these are leveraged transactions, so the amount of liquidity that a shareholder is able to achieve from one of these transactions is dependent on the company's ability to borrow the funds. Therefore, employees are not required to pay for the stock of the company, but still, again, achieve the economic benefits of ownership. ESOPs, at their inception in the 70s, when all of the laws were passed around employee ownership, really had wide, broad bipartisan support in Congress, with the notion that employee ownership really does improve the competitiveness of businesses. So Congress really felt that employee ownership would make U.S. companies more competitive, and give employees an opportunity in ownership of a company that they otherwise might not have. So as such, Congress passed a number of tax laws that accompany ESOPs that really are there to incentivize owners to consider this option, and to help these companies be more have more cash flow to repay the transaction debt and to become competitive over time, which really results in greater retirement benefits for the employees over time.
So Julie, let's talk about some of the sort of key attributes or features of an ESOP that make it attractive in business transition.
Sure.
Next slide.
Mark touched on this. Yeah. Mark touched on this, and this is really about objectives. What are the objectives of the selling shareholder? I think we can all, it's fair to say that most owners do appreciate to achieve maximum price when they sell their business. I mean, achieving value for your accomplishments is a clear goal of most owners. But there are a lot of owners out there, and in my time in this business, I've spoken to countless owners who, they really do have other priorities and objectives that either are on the same level as price, or in some cases might even be prioritized above price. And those more emotional and qualitative objectives are some of the more salient benefits of ESOPs and why ESOPs resonate with some business owners, in particular in a time like we're in now with COVID. There's a lot of disruption in the marketplace. So ESOPs tend to do well in all economic times, because these qualitative and emotional benefits that they provide are really constant throughout any economic period. So one of the most, I would say, common themes of owners that they talk about who are gravitating to ESOPs are those who have really put an emphasis in prioritizing the culture of the company. Selling your business to a third party certainly jeopardizes that continuity of culture, and in going hand in hand with the employees, Owners often want to protect their employees and make sure that there isn't significant disruption, either in the sense of layoffs or just a change in the culture that's negative for the employees in a long-term basis. So these more emotional and qualitative benefits are marquee to ESOPs. They're really one of the primary advantages. ESOPs are also known as a friendly buyer. It's a ready-made internal buyer. So again, in a marketplace like we have today, that's a really important advantage and can give an owner the opportunity to do some things with their planning and maybe achieve some liquidity at a time when it might not be possible, to achieve liquidity through another way. ESOPs are very, very flexible. That flexibility, again, in today's market is really important. I'm seeing a significant amount of minority interest transactions or smaller transactions. Owners are feeling the need to take some chips off the table while they can and diversify perhaps. And if you do that, and if you take chips off the table today using an ESOP, you can always recap down the road, sell more to an ESOP or sell the company if that's the ultimate intention for the owner. So that flexibility is a really important tool that we use with ESOPs in order to match a transaction with the objectives of the owner. Again, along the lines of that flexibility, an ESOP you can sell any percent to an ESOP from a very small percentage, 5%, up to 100%. And the ESOP can pay fair market value. To kind of connect this to Mark's comments, fair market value is the price that a willing buyer would pay for your business. Not a specific buyer, but a hypothetical willing buyer. So in some cases, fair market value might very well be what you can achieve selling the business in a market to a third-party buyer, like a private equity or strategic buyer. And in other times, it might not. In today's market, there's limited supply of companies that are targets for acquisition, given the impact that many have experienced in the pandemic. So, with limited supply and certain buyers out there with a lot of capital to put to work, multiples in certain areas can be really driven up, and that might exceed fair market value. So you don't know until you do the analysis, and that's part of your planning. But, fair market value is certainly fair, and it can compete very well with third-party players at times. Like I said about Congress, supporting ESOPs, there are tax benefits that are really motivating shareholders or owners to consider sale to an ESOP. In particular, for the selling shareholder, you may be able to defer capital gains tax on a sale to an ESOP if you meet certain conditions and if you are eligible. With our time today, we don't have a lot of time to go into those eligibility requirements, but you can really achieve, a transaction that on an after-tax basis can compare quite favorably to a third-party sale when you consider a transaction where you're not paying capital gains tax. That's a really motivating factor for ESOPs. For the company, again, the idea being that we want to make these employee-owned businesses strong and able to repay debt and be competitive in the marketplace. So there are significant tax deductions for the company that's a minority ESOP-owned business. And in the case of 100% ESOP S-Corp business, the company would pay no federal or state income taxes, which clearly is a compelling competitive advantage if you can get to that point. And many, many owners do choose to sell 100% for this reason. The company doesn't become tax exempt. It's just that the shareholder here, which is the tax exempt trust, the retirement trust, is tax exempt. So in the context of an S corporation, which is a pass-through entity, the company wouldn't need to make tax distributions to its shareholder who does not owe taxes. So that 100% S Corp ESOP is a significant competitive advantage and something that a lot of businesses strive for. Again, the marquee benefits of employee-owned businesses are the employees. The employees achieve ownership without having to pay for the stock. They do accumulate retirement balances that on the whole exceed the retirement balances that non-employee-owned businesses employees would typically achieve. So a lot of studies out there to demonstrate this, but it can be pretty meaningful in the range of 4 to 5 times the retirement balances on average for employee-owned businesses compared to companies who offer other types of retirement planning. You know, I mentioned earlier that these are not for key employees, but are broad-based plans. You can structure transactions that do benefit and give greater incentive to your key employees through plans that exist outside of the ESOP, like stock appreciation right plans or phantom plans. So I think trustees and people who are planning these transactions are aware that there are reasons to motivate your senior leadership in the organization, and broad-based ownership is great, but it's also very common to give additional incentive to those key leaders. And finally, employee ownership aligns the interests of the company with that of the employees. You know, you tend to get better engagement, better retention, great recruitment. So, you know, this is a win-win from the perspective commonly from the shareholder to the company to the employee.
Julie, one of the things that Mark mentioned earlier is just dynamic times and unprecedented times because of the pandemic. How do, you know, I'm not sure we'd be talking about ESOPs. We, SBAM, would be talking about ESOPs right now, but there really, there are some advantages in thinking about this post-pandemic. Talk about those advantages.
Yeah, I mean, so the pandemic has had clearly an impact across the broader M&A market. So an ESOP is a type of M&A transaction at its core. And this virus, the COVID, has had an impact across all companies, but it's dynamic, to use Mark's phrase. This isn't, there isn't one impact for a given type of company. There are a lot of different impacts depending on what sector you compete on or company specific. So the best way to answer this question on how this current environment is, how ESOPs are faring under the COVID environment, is to think about what those groupings of companies are. You have companies who you know, are quite distressed, who have been significantly impacted, and those companies, you know, buyers will be scarce for those companies today for obvious reasons, and valuation will be a real challenge. So it might not be the right time for those business owners anyway. In the context of an ESOP, that's true too, right? The ESOP is a regulated retirement plan. And so these transactions are negotiated on an arm's length basis. So while you have a built-in buyer, you still have to have a fair transaction, which means that if your company, you know, is in distress or is moderately impacted by COVID, your valuation will similarly be impacted with an ESOP. And, you know, you'll have probably deal structures that might make it less appealing to do a deal in this market. For companies that are modestly impacted or not impacted at all, you know, the great news is we initially saw a drop off in transaction activity, both in the broader M&A market and for ESOPs, but that's really begun to tick up, and buyers are starting to, you know, get creative with those businesses and structure deals where you share in the risk of the uncertainty that's out there. So we are seeing deals in the ESOP market as well as in the broader M&A market with modified deal structures that might include escrows, earnouts, and clawbacks, for example, to help buyers and sellers share in the risk that's out there. And then you have these companies, and I've seen a lot of them in the last few months, that are benefiting from COVID. And those ESOP transactions and broader market transactions are getting done. The thing with ESOPs, again, they're a built-in buyer, so you don't have to worry about whether the buyer's out there, but the deal has to be fair. They are leveraged events, though, so access to credit is a really important consideration today. There's less debt in transactions. You have to be a very strong company with very little, if any, impact of COVID. So the thing to consider here is access to credit, but understand that ESOPs are flexible. You can do smaller deals. You can do a seller finance deal and recapitalize that in a year or whenever the markets improve. So that flexibility is really important for ESOPs in a time like this. And again, you might have reasons to need liquidity, and so ESOPs are there in those types of situations. And then finally, the fundamental benefits of ESOPs are unchanged. They're flexible, they come with tax benefits, they help you protect your culture and legacy and employees. So, you know, this is one of the key reasons why ESOPs remain strong in most economic environments.
Well, thank you, Julie. Appreciate spending some time on ESOPs. Let's pull back a little bit now. I wanted to make sure we had a chance to talk about the sort of end of year, what's coming. There's an important presidential election that's coming, some tax issues that are kind of on the table. What should business owners be thinking about as it relates to this? Let's go back to you, Dan. What should business owners be thinking about right now?
Well, it's interesting because regardless of the presidential or the congressional elections, the U.S. has got to put itself back on a path. We have to pull ourselves out of the current financial drought that we're in, as well as figure out a way to pay off the amount of debt that we've taken on just due to COVID. And, something that Mark and I do quite a bit of is, we read and we listen to and we sit in on a lot of webinars, and we've heard a lot of what the pundits are saying as far as, what some of the potential tax changes might be if there's a change in the White House, or if there's not a change in the White House or with the Senate. It's anybody's guess as far as what's truly going to happen. But what I would recommend to business owners, at least, and this is, going back to earlier in the conversation where, Mark and I were talking about the business and the personal, we need to look at it that way as well. And so from the business standpoint, a few of the things people need to keep an eye on is, number one, the capital gain rate. I believe it was Joe Biden's proposed plan might have an increase in the capital gain rate. Now, that's just not a unique thing for Joe Biden. Capital gain rates have gone up and down for decades, going back to the Reagan era. But it's something to keep an eye on because if that capital gain rate were to change and you were kind of banking on a lower rate, maybe you would have engaged in a transaction at the end of 2020 as opposed to waiting until 2021, or perhaps you've got capital losses. So that's one thing you want to keep an eye on. The qualified dividends rate as well is another thing that individuals, especially if you own shares of stock in a corporation, the qualified dividends rate is also something that could, quite frankly, go away, or it could be increased. It could be a different rate than the capital gain rate. Those are really easy ones for a Congress and a president to just simply change the rate in order to increase revenue. But a few of the others that could potentially be something to keep your eye on is the 199A qualified business income, which was something that came in 2017. And that's something a lot of small business owners may have been able to take advantage of, and their accountants went crazy trying to figure out how do we calculate QBI, but that's something to look at. Net operating losses, which was also changed in 2017, but then was changed again with the CARES Act, this past spring, and then the AMT. So these are all kind of the business side of some of the taxes that we need to look at. But what we need to keep an eye on, and this is something that we saw in 2010, as we were coming out of the 2008 election, was the extension or the expansion of some of the Bush era tax benefits that Obama continued on. But there was a period of time where in 2010, where there was no estate tax, but what some people didn't realize was that, the payment for not having an estate tax was no step up in basis to fair market value for appreciated assets. So, we need to now start gravitating over to the personal side, which is where a lot of the, the tax changes that you hear people talking about, could potentially happen. And so, one of the few certainties that we do have, and you'll see on the next slide, is what is on the books today. And, that's what, Julie Williams, Mark Rheaume, and I have to do, is we have to look at the law as it is today. We can't speculate what's going to happen tomorrow and have people commit themselves, but we have to be aware of that. And so what we do know right now is that the estate and gift tax unified credit is supposed to go back to the levels that it was pre-2017, when the unified credit amount was at 5 million. If you could please go one more slide, you can see it. So a realistic question, though, for a lot of our practitioners is, there you go, is whether the unified credit amount is going to get pushed back. If you look on the far right, you'll see 2026 and beyond, the estate tax exemption and the gift tax exemption is at $5 million. Right now, in 2018 and through 2025, before it sunsets, it's supposed to go up. And so right now, we're at about a little over $11.5 million per person. Those are the things that we use when we're doing an estate plan, when we're doing some tax planning with a transition of a business. That 2026 though, could go away. And that might be retroactive to January 1, 2021, if Joe Biden were to come into office, for example. We don't know that that's going to happen. It could happen, but it might not happen. So there's a lot of these countervailing forces. But what I will tell you, and what Mark and I went through, you know, a little over 10 years ago, is that we recommend that the business owners sit down with their CPA and their estate planning attorneys right now to figure out what is the homework that you need to be doing. Do it today in September. And the reason why we tell business owners to do this right now and why you want to do this before the end of the year is so you can at least get into that meeting in late November, so after an election, so we know who may or may not have won with the Senate and with the presidency. Now you're into late November, perhaps December, where you can actually have a meeting where maybe you're going to start executing some documents. You know, at least have a little bit of a better idea. Because if you wait until the end of the year or you wait until after the election, I can tell you firsthand, nobody's going to have time to sit down with you because they're going to be filled, their schedules are just going to be filled up. And so you get your homework done now in September and in October and sit down with your advisor and find out what are some of the things we need to be thinking about and what kind of documents might we want to lock into. You know, and one of the things that Mark is going to talk about, you know, estate planning with lower interest rates. Because there are a lot of these options out there that we can play with, but we need to know what exactly are we looking at today in September so we can anticipate that plan being executed towards the end of the year and have it, you know, then come into motion in 2021.
So indeed, as Dan said, there's some urgency, Rob. Well, what we're suggesting is a whole menu of items that can really impact an individual. The big picture, though, from an estate and gift tax standpoint, is this is probably the most optimum time to reflect on whether or not it's an appropriate time for gifting. And if it is an appropriate time for gifting, we'll probably want to take advantage this year of the large exemption, $11.58 million. And it could very well be a use it or lose it concept, Rob. We may never have this opportunity again. So although we're not alarmists, in the right circumstances, there is certainly some urgency to understand the menu of circumstances that can affect the business by year end. And optimal planning will probably learn to take advantage of gifting, advanced gifting. Most people are certainly aware of the annual exclusion amount, $15,000 or $30,000 for a married couple. But really, you can gift $11.58 million per individual. And the question is, should we begin a gifting program? We're often with clients who don't anticipate transitioning their business, but gift in advance. And oftentimes in a non-voting interest, could be non-voting limited liability company, non-voting corporate stock, even in an S corporation, we can have non-voting stock, but maybe begin priming the pump so that all of the appreciation in the business, which is to come as we recover, as we get beyond COVID, as we get to our new normal, that appreciation is outside the estate of the individual holding the business. So we really feel compelled to discuss urgency for dialogue, urgency for putting together the appropriate team that can see how all the picture works together and to take advantage of those discounts. Now, those discounts include a discount for marketability, a discount for minority interest, and we often speak of a COVID discount, and that is to the extent cash flow has been disrupted, to the extent free cash flow, EBITDA, has been adjusted negatively, that's an additional discount. So we could actually gift at a very, very, very effective rate and let that appreciation in the future come to the next generation. So really, as Dan said, the need to plan is now. We're facing October right around the corner, and we'd really like to get plugged in and have some active dialogue, whatever it might be, whether it's cash flow needs, whether it's dynamic planning, what is evaluation, how does all this come together? How do these alternatives come together, and how do they reflect in their personal plan? It's really a critical focus.
And Mark, one of the things that, is also unique at this moment right now are very low interest rates. And that creates some opportunity as well. Let's go to the next slide and talk to us about what are some of those opportunities.
Certainly from a commercial standpoint, take advantage of the low interest rates. Remortgaging is at record rates. Now, beyond that, the IRS stipulates an interest rate, and that interest rate is at historic lows. So we are now able to make preferential transfers generally to families in a way that is highly advantageous because the interest rate is a fraction, a small fraction of what it used to be. And all we have to do is earn over and above that small fraction, which is generally less than 1%. So we have various instruments, the grantor retained annuity trust, loans to family members, sales to defective grantor trust. We have a number of things we can do to really work with the stated low interest rates and accomplish some really wonderful gifting programs. So it's just the convergence of the way things work. And in this case, interest rate is going to remain low for some time, but the concept of gifting and utilizing the exemption amount, as long as it's as large as it is, requires that kind of planning. So we are actively talking with clients about grantor retained annuity trusts, otherwise known as GRATs, and other forms of transfers into trust, which are discounted by a very, very low interest rate, which help us leverage and really make the trust grow to the extent the fair market value of assets can exceed that low interest rate. So really unique times. Dan, you want to embellish on that?
Well, the one thing I might just want to add on quickly is, and some of the other types of, advanced planning documents that we work with another type involving spouses called the SLAT. Mark mentioned the loans to the family members. A lot of times the interfamily sales are also a very effective method of transferring a business. So rather than gifting away the family business, as I mentioned earlier in the presentation, you could do a sale. You could do a family sale. You could do it on a long-term note and discount that as well. So there's a lot of interesting things that we can do planning-wise, and this has nothing to do with tax. It's just dealing with the economics that we're dealing with historic low interest rates.
I want to go to one more topic before we wrap up here today, and that is, I think, Mark, you mentioned life insurance, and how does that play? Dan, let's go to you first. How does
Sure.
think about the use of life insurance at this point?
Sure. Well, life insurance has always played a big part in just estate planning, but also in business planning. And, part of it, as Julie was talking about, Congress will pass certain tax benefits as incentives. One of the tax benefits of owning life insurance is the fact that when you receive a death proceed, it's free of the income tax. So it's excluded from the gross income. In some instances, you might be able to, maybe if the business owns the policy, you might be able to qualify for a deduction for those premiums. So, there are a lot of benefits to owning life insurance from just a tax standpoint, or some of the tax benefits that are in the Internal Revenue Code. But for families and business owners, if a lot of your wealth is tied up into a business and you don't have the liquidity that you might need in order to, let's say, pay, an estate tax, or to pay various expenses as a result of the death, or to maybe pay the purchase price for the sale of the business. This can provide a lot of liquidity to the family, and they're able to do it. Mark and I work with a lot of business owners, with an insurance review through one of our partners, the M Group. And one of the things that Mark and I like to push is, making sure that with a buy-sell agreement, for example, between existing shareholders or existing members, that it be funded with life insurance. And we want to make sure that we've done a proper life insurance review to make sure that that's the appropriate policy. Key employee retention. There's a lot of really good uses of life insurance in business planning, and something that business owners need to be aware of. And before I turn it over to you, Mark, real quick, one of the things that we've heard, and I haven't seen it yet, but I've heard a lot of talk about it, is that the underwriting standards might be changing as well for a lot of the life insurance due to COVID. And you don't hear a lot of the pundits talking about that. That's something to be very mindful of if you're a small business owner and you're even considering life insurance. Is maybe you need to speed things up a little bit to make sure that the standards haven't been changed in any dramatic manner.
Good point.
So Dan and I often speak of being reformed attorneys. So we tend to be fairly critical. And one of the things we find is, people don't understand their estate plan. And it's really, really important that they understand the pros and cons of what they've established. And I would submit the same is true with respect to buy-sell agreements. So there is a tie into insurance here because we often review buy-sell agreements, and it's not unusual for them to be 5, 10 years old, with provisions that really no longer apply. I recently sat with a group of shareholders, and there was a mandatory buyout upon retirement, and the person that was retiring had no intention of withdrawing. So, they had to amend their agreement to really think about what are the provisions they want to have alive and binding each other. So not only is insurance really, really important to buy-sell agreements, and I have to say it's often overlooked. Not only that, is the ownership appropriate? Are the designated beneficiaries are appropriate? Is the level of insurance and the insurance coverage appropriate under the circumstances? But mostly, I would say understanding your buy-sell agreement in plain English. When something happens, are you comfortable with how you have the provisions read? Are you comfortable with the literal provisions of your buy-sell agreement? It's really, really important. And the valuation, by the way, contained within buy-sell agreements oftentimes doesn't neatly fit and doesn't fit well with respect to true fair market valuation. So having an overall review of the insurance needs, the family needs, and then how does it impact a buy-sell agreement if the one's in place is really so fundamentally critical, because by the time something happens, it's too late. And we have actually seen that. So we really want to avoid any of those kind of tragic circumstances.
Well, let's kind of bring this home. Talk about next steps for a business owner. Let's pitch it to you, Mark.
All right. So, really fundamentally, I'll try to keep it simple. We're talking about risk analysis. De-risk your personal circumstances by understanding how your financial plan is intertwined with your business goals. De-risk your personal circumstances. Go through, understand, predict, have current values. Again, we often find life insurance includable in the taxable estate. Many times that's inappropriate. So there are ways of transferring that insurance. But not only align and de-risk your personal circumstances, but understand, particularly this year, how are you impacted by COVID? What should you be doing by December 31st? How should you assemble your advisory team? Is your advisory team really working in your best interest? Have they covered these issues with you? If not, it's time for a greater, deeper dialogue and open it up so that your professionals can collaborate in your and your family's best interest. Because primarily, what we want to do is seek to protect and preserve your legacy.
Very good, very good. Hey, we have one question. I just want to see if we can get it in real quick. And the question I'll give to you, Mark, is do you find PPP loans complicating deal structure because they haven't been forgiven yet?
I think they certainly can potentially complicate the structure. Like any due diligence, though, if you're a good business, if you're tracking as an attractive candidate for acquisition and a target of acquisition, we're all fully beginning to understand the circumstances surrounding PPP. So I would say it is absolutely a factor in due diligence. As we move along, each passing month, we're acquiring more and more knowledge. We're understanding how PPP is affecting the businesses, what the next steps are. So honestly, they should not seriously affect deal flow. The COVID impact and the disruption, and then the projection of earnings is probably the most important aspect of deal flow. But the PPP is just one more factor that we're all getting much more comfortable with. How do we deal with? What are the rights, obligations, and duties? And how do we deal with those?
Yeah. Well, thank you, Mark, Dan, and Julie. Appreciate so much your expertise and sharing it with us. I want to thank everybody for joining us today. It's been a good education. I was reminded as you were talking, I heard this years ago, entrepreneurs are people who say, if I die, not when I die. And I think it is, planning sometimes goes by the wayside because that's just not going to happen to some entrepreneurs. Thank you for joining us today, and thanks again to PNC.